Welcome back everybody to another video. I hope you guys are having a good trading week. So in today's video, I wanted to talk about news and more specifically how to trade news with futures, because as you guys know, within the day trading industry, there are two types of analysis. We have our technical analysis, which usually deals with chart patterns, indicators, correlation with how the market moves. And then we have our fundamental analysis. And what I like to say with the fundamental analysis is that is more dealing with the what, when, and why of price. What is going on in the market? When is it going to happen? And why did it happen? So our fundamental analysis is more like a post observation of why, when, and what price did at a given location. So within futures, contracts are influenced by a variety of news and events, primarily those related to economic indicators, geopolitical developments, financial markets, and industry-specific news. So in this video, I want to highlight some of those key factors and really talk about how to understand news from a fundamental approach so that you can maximize your profits. Let's go ahead and dive straight into it. So starting off, we have economic data releases. So within every economy, there is a central bank. Now, the central banks pretty much control the economy's growth, and it has two typical mandates, which are inflation and full employment. Now, the first point is interest rates. And why do I have this listed? Well, interest rates are in correlation of inflation data because the theory goes that if interest rates rise, the economy means that it's boosting, which means inflation is growing. And because inflation is growing, interest rates are higher. So if interest rates rise, it strengthens the currency. If interest rates fall, it weakens the currency. And in the futures market, the cost of carry refers to the total cost of holding or carrying an asset until the contract's expiration. For some commodities and financial assets, this includes storage cost, insurance, and more importantly, interest rates. If interest rates rise, the cost of holding a cash position increases, which can push investors toward futures contracts to avoid the cash holding cost. This shift can drive up demand for futures, adjusting prices for the new rate environment. And vice versa, when interest rates fall, the cost of carry decreases, potentially lowering future prices. And this image down here is pretty much the gist of it all. So the central bank is kind of like the main piece and component, and they have two mandates or monetary policy, which fall in line with inflation and full employment. And the central bank makes decisions off of how the inflation is looking like in a country or how the employment rate is looking like in a country as well. And then we have inflation data. So data reports like the consumer price index or producer price index, which we'll talk about later into the video. These reports pretty much show the growth of a country in terms of inflation, how much consumer spending is happening in a month or given time period, how the housing market is looking like. The consumer price index tells us what inflation is doing. And we'll talk more about this later into the video. But with the consumer price index, we get an idea of how much spending is going on in a certain time period. And the central banks have a mandate to keep inflation at or slightly above 2%. And then we have employment data, non-farm payrolls, unemployment rates, and other job market statistics. If you guys didn't know, the biggest news event is actually unemployment, which is NFP. Everything stems from employment. If people are working, they are making money. If people are making money, they are spending it on goods. When people spend money on goods, prices tend to go up. And how does the central bank react? They raise interest rates. And this encourages people to borrow less and save more. So the central bank looks at the average earnings, retail sales, durable goods, and compares it to the month prior. And I just want to emphasize once more, this is a lagging indicator. If this told us what price we're going to do prior to news, everyone would be rich by now. But one leading indicator, which I'll talk about briefly, is the PMI, which is the Purchasing Manager Index. It's basically a survey asking business leaders, local banks, manufacturing services, what the outlook looks like for the economy. And anything over 50 means the economy is expanding. I know I don't have it up on the screen right now, but later into the video, as I talk about the economic calendars, such as Forex Factory, I'll show you guys what that looks like and how to find it. And last but not least, we have GDP reports. So gross domestic product is the monetary value of final goods and services. In simple terms, it's basically the overall health of an economy. So all of these components play a huge role on the economic data releases. Next, I want to talk about the Federal Open Market Committee. So once a month, the FOMC, they come together to discuss the interest rates of a country. and they make decisions based on the economic growth of that country. And you guys might have seen some faces on the thumbnail, but some of the 2024 committee members involve Jerome Powell, John Williams, I believe this is Philip Jefferson, and Christopher Waller. And there's a lot more people on the list that I'm not going to go over, but these people who are part of the committee, they come together and they discuss potential changes in interest rates. And then on the economic calendar, one popular website, which is Forex Factory, this is what it pretty much looks like, where we have the red folder and the news announcements. So federal funds rate, FOMC statement, FOMC press conference. So the next category that I want to go over is geopolitical events. Uncertainty increases risk perception. What do I mean by that? Well, geopolitical events inject uncertainty into financial markets, prompting investors to reassess risk perceptions and adjust investment strategies accordingly. Investors react to geopolitical events because they can disrupt global trade, affect currency values, and alter central bank policies, all of which impact investment decisions. Central banks may adjust interest rates or implement monetary policy measures in response to geopolitical events to stabilize financial markets and support economic growth. One example could be events in oil-producing regions or areas that have major energy exporters that can disrupt global energy markets, leading to fluctuations in oil prices, consumer spending, and inflation expectations. Some of the major key pointers involve political instability, elections. So this previous week, as Trump was elected as our president, we saw a few hikes in certain currencies, which I'll talk about later into the video. But that is one of the key components when it comes to uncertainty. When a president is elected, we don't know what's going to happen. But once it does happen, we start to understand why. We have trade wars and tariffs, so changes in international trade policies or disputes. And then we have wars and conflicts. Government responses to geopolitical events, including sanctions, trade policies, and fiscal stimulus measures, can impact market sentiment, economy growth prospects, and corporate earnings. Next, we have natural disasters and weather events. So severe weather can affect commodity futures such as oil, natural gas, and agriculture products. Events like hurricanes, droughts, or floods can disrupt supply chains, impacting prices. Hurricane Helene is a great example. So hurricanes are among the most destructive natural disasters with far-reaching consequences for economies, communities, and financial markets. When hurricanes hit, they can send ripples through a wide range of industries, from energy to construction. So during hurricane season, investors often see increased volatility in energy stocks as fears of disruption can push prices higher. Companies such as ExxonMobil and Chevron are directly impacted by these shutdowns. So here on TradingView, I'm on ExxonMobil, which is the XOM, and I just want to see if that data is relevant to how price reacted. So if we find the 26th at which the hurricane hit Florida, let's go ahead and find it real quick. September. So around this area, let's get the replay button and place it just about here. If we come down here on the daily time frame and click play, notice how price forms a gap before initially pushing up. And I want you to notice the volatility in these bullish candles. Notice how there's no gaps. It is nice bullish consecutive candles. So price was bullish. Let's go ahead and check Chevron real quick. So this is the CVX. Let's go ahead and get the replay button. Let's find the 26th of September. So right around this area, we go ahead and click play. We're on the 25th. So the next candle is going to open on the next day since we're on the daily time frame. Let's see what happens. Okay, so same thing. Notice how we form a small gap and then price was bullish. So the information is accurate. I'm going to repeat it once more. Investors see increased volatility in energy stocks during hurricane season as fears of supply disruption can push prices higher. So why is this important? Well, if I was trading this financial instrument, I would have an idea of what price was going to do off of historical data and things I know that happen in hurricane season. Okay, so next we have industry-specific news. Energy sectors such as oil and gas inventory reports, OPEC meetings, and shifts in energy production. We have the agriculture sector, crop reports, planting forecasts, and changes in agriculture technology or policies. Now, we don't have to worry too much about this because we trade futures And within futures, we trade stock indices such as NAS, S&P 500, and commodities such as gold. And the agriculture sector isn't traded on the central exchange, the CME. It's actually traded on the CBOT, which stands for the Chicago Board of Trades. And I'm pretty sure I talked about it in one video before, but crops, planting forecasts, and changes in agriculture technology or policies all have to do with the CBOT, not the CME. Okay. And the last factor is technology and manufacturing. So announcements about advancements, supply chain issues, or shortages. Next, I want to talk about the global financial markets. So the first factor is stock market performance. Correlation between futures markets and stock indices like the S&P 500 or Dow Jones, currency fluctuations, exchange rates can impact futures tied to commodities. So exchange rates affect futures markets by influencing the cost and demand for commodities, cross-border investments, and the stability of financial assets globally. For instance, a strong US dollar could lead to decreased demand for US products globally, impacting futures prices for those commodities. And the last factor being bond market movements. So changes in yields that affect the overall market sentiment. So bond prices and interest rates actually have a inverse relationship. When interest rates rise, new bonds offer higher yields, making existing bonds with lower yields less attractive, which pushes down their prices. Conversely, when interest rates fall, existing bonds with higher yields become more attractive, increasing their prices. Now, the central banks like the Federal Reserve play a huge role here. If the Fed raises rates, bond prices typically drop. If the Fed cut rates, bond prices tend to rise. And when it comes to overall market sentiment, I think I talked about this in that video as well, but there was a certain website which allowed us investors to see the overall sentiment of price, if it was overall bullish, if it was overall bearish, to determine what the market was going to do. So next, I want to talk a little about commodity supply and demand factors. So as we know, when it comes to our technical analysis, we often use smart money concepts such as supply and demand zones, where we're waiting for price to hit a demand zone for buying interest, or we're waiting for price to hit a supply zone for selling interest, right? And when it comes to the economic approach, well, these fluctuations often come from reports on supply chain disruptions, production cuts, or new sources of supply. So here I have this image kind of representing what this looks like. So whenever we have a lot of quantity, supply tends to rise. And whenever we don't have a lot of quantity, that means demand is high. You can think of it like your iPhone, right? If there was less of this product, there would be more demand. If there was more of this product, if there was an oversupply of iPhones, prices would be much lower, which is why there's an interest of selling when you're at supply because it's overbought, and a interest of buying when you're at demand because it's oversold. Hopefully that makes sense. Monitoring these type of news and data releases can help you understand and anticipate potential movements in futures contracts. So some of the main websites that I use for my fundamental analysis on a day-to-day basis includes forexfactory.com, Fxstreet, CME Group, and CNBC.com. Now, you can feel free to use these websites, and I'll briefly go over each one, but you'll know that you have a good calendar to look off of if they come with these factors. If they include job reports like non-farm payrolls, if they include inflation data like the CPI and PPI, if they include the GDP growth rates, and if they cover the central bank meetings. These reports often cause significant market reactions, and futures traders can anticipate volatility around these times. So real quick, I just want to go over each website. So starting off with the first one, we have Forex Factory. This website is probably an all-time favorite because I have been using it for the most time since my transition from Forex to futures. But let's just go over it real quick. So on the economic calendar, you have your date, you have your time, and then you have the currencies being affected by whatever news announcement. So for example, it is Monday, so it was a bank holiday, which is why I didn't trade. But let's go ahead and go on Tuesday and try to find an important news announcement. Okay, so boom, on the 13th, on Wednesday, November 13th at around 8:30 a.m. Eastern time, we have the core CPI announcements, which is high impact. You can tell off of this color, which will affect any asset that involves the USD currency. So here on the right, I think I talked about this briefly, but here you can see the previous forecast and actual. Now the actual won't print until the event actually happens, but here if you click on this folder, you can get information on why this news announcement is important. So why traders care? Consumer prices account for a majority of overall inflation. Inflation is important to currency valuation because rising prices lead to the central bank to raise interest rates out of respect for their inflation containment mandate. So like I mentioned at the very beginning of the video, whatever news announcements you're looking at, whether if it's high impact or not, it's not going to tell you if price is going to buy or sell, or if it's going to push bearish or bullish. Otherwise, everybody would be rich. The main purpose of this is to give information on what the central bank is going to decide off of their inflation rates. So the consumer price index specifically accounts for a majority of overall inflation. And I do believe that an overall good standing for inflation is 2% or slightly above. So as you can see over here at the actual forecast, we have the percent in which prices changed previously. So it's not going to give us what it's going to do until it actually happens. But looking at historical data, we can see that October, it was good. September, it was good. Excuse me. August, it was good. July, it was down. And in June, it was also down. So as you can see, these numbers aren't too far apart, but this will tell you overall how the economy is doing in respect to inflation. Let's look at another example. So I want to try to find the PMI because that is a forward-looking indicator, meaning that investors like you and I can actually predict what price is going to do off of the data that is being released. Let's just see if I can find it real quick. So boom, I found it. Here we have the French flash manufacturing PMI on the Friday of November 22nd at around 3:15 a.m. So this announcement is high impact news, which is going to affect any financial asset involving the euro. And as you can see to the far right, we have the previous number. The forecast is blank and the actual is blank because the announcement hasn't hit. But as you can see, the previous forecast was around 44.5%. Anything over 50 means the economy is expanding. So again, this is a forward-looking indicator because the central bank likes to get a heads up on what the economy is looking like based off of the PMI. And then down here, we have it at 49.2, reaching that 50% level. And let's look over here. It says 51.6. So it seems like the economy is pushing up when it comes to the euro asset. And then you can read up on information. Why traders care. It's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. Just like I went over with Hurricane Helene, one useful factor that investors use, such as you and I, is historical data. So if you don't know what price is going to do or you're unsure, all you have to do is look back prior to when we had a news announcement to see and analyze how price reacted to it, okay? So the next website I use is Fxstreet. We're just gonna briefly go over this. I used this website a lot when I was live streaming last year, just to pretty much get an update on why price did what it did, whether if I was trading the euro, Australian dollar, the yen. All this information was provided on this website. And one thing I really like about this website is that it also provides an economic calendar. If you go right here, click right there, just like Forex Factory, it will give you all of that information. And then the next website I have is CMEgroup.com. So CMEgroup.com, or you can just type in CME.com. This website is primarily helpful for those that are making that transition to futures because it provides information on stock indices. So you go to markets, you can see that all of these indices are provided, and you get all that information over here when it comes to the specs, when it comes to the volume, when it comes to the overview. CMEgroup.com provides all that information. So primarily for future traders, I suggest going on CME Group. This website also provides economic research. So if you go to the main page, click on Insights, and then you go to Economic Research, it will provide you with loads of information. So here it's talking about Bitcoin, it's talking about China, and other things that can help with your fundamental analysis. And last but not least, we have CNBC. So CNBC is pretty convenient because it combines all that information I just talked about and puts it on one website. And it also provides relevant news that's going on live. So here we have live information on the S&P 500 futures. We have a whole bunch of market data and markets to look at, whether if we're trading US markets, currencies, cryptocurrencies, futures and commodities. Everything that you need is on CNBC, which I really like. So with Forex, if I'm trading Forex, then I would usually just go to forexfactory.com and Fxstreet. If I'm mainly sticking to stock indices, then I'll use websites like CNBC, and CMEgroup.com. So how do we actually identify these key market drivers? I'm going to speed through this pretty quickly because I don't want this video to be too long. So let's go ahead and get straight to it. So for commodities, you want to pay attention to supply and demand news, weather reports, geopolitical tensions, and production data. For stock indices, you want to look at corporate earning reports, macroeconomic data, central bank policy announcements, and broader market sentiment. So with the corporate earnings reports, I have this image below, which kind of make up what S&P 500 and the Dow Jones is. So within these stock market indices, we have companies like Under Armour, Microsoft, Coca-Cola, Intel, MasterCard. For Dow Jones, we have similar companies like Coca-Cola, we have Nike, we have the Goldman Sachs. So basically, you want to keep an eye out on these earning reports, and websites such as CNBC give data to back that up. And I actually missed that part, which I want to go over real quick before my OCD kicks in. If you go on the homepage, click on markets, and then you go to US markets, and then we go to Dow Jones, you can actually get data on what the interest of that company is looking like. And if you click on change, you can actually see the change of rates fluctuating within each company. So here we have Microsoft, we have Apple, we have Walmart. I know this looks confusing, but in simple terms, if it's red, that means it's doing bad. If it's green, that means it's doing good. And as far as the central bank policy announcements, information that we covered, such as the FOMC, when they come together and talk about the interest rates of an economy, that's also important. And broader market sentiment, if investors are anticipating price to be bullish or bearish in a given asset. For currencies, you want to focus on interest rate changes, trade relations, and fiscal policy. Political events can also trigger volatility. So here is actually an image of Bitcoin, and I actually have it here on TradingView, but notice how Bitcoin is just pushing up, and this is post Trump victory. So a Bitcoin rally after a Trump win could result from perceived market-friendly policies and expectations of reduced regulation, concerns over inflation, and general investor optimism or speculation around the potential effects on the crypto market. So I just found that pretty interesting that Bitcoin has been skyrocketing post-Trump's victory. And you'll see things like this all the time where you have a lot of spikes in the market off of political events such as the election that you want to pay attention to, because whenever there's a push or a spike, there has to be a phase of exhaustion. So although Bitcoin is looking really bullish right now, I checked my portfolio on Coinbase, and let's just say it made your boy pretty happy. But there's going to be a phase of exhaustion where price also has to rebalance itself. So price could have a huge retracement back down to a given area to fill that gap. But we'll just have to see. But that's just something pretty relevant, I guess. I just found that interesting in terms of currencies and cryptocurrency. Main point being that political events can also trigger volatility. As far as interest rates, you want to watch for central bank announcements, inflation reports, economic data, and other indicators of economic activity. And again, all those websites that I listed provide that information. And then this image is just showing you that when interest rates are down, stock prices are higher. When interest rates are higher, stock prices are lower. So next, I want to talk about understanding market sentiment. News often drives short-term sentiment, so monitoring media sources for shift in sentiment is important. And sentiment is basically the perceived notion of price, whether if it's going to be bearish or bullish. And as you can see on this chart, I'm just kind of visually showing you guys the meter that is usually displayed, whether price is going to be bearish or bullish, and whether price is going to be strong or weak. So when it comes to your fundamental analysis, positive news can boost stock index futures, while negative news can spike demand for safe haven assets like gold or government bonds. Next, we have the correlation with historical data. Historical data and chart patterns using technical analysis can help predict potential price movements when similar news emerges. Just like I talked about not too long ago, the good thing about price is that it respects history. Whenever you have a gap in the market, right, where price makes its way back down to an order block, it respects that area because of history. Price showed that before it reacted in a way that it might react in the present. So when it comes to news, one way in which we predict price movement is by looking at historical data that suggests that price is going to move in a similar way off of a given concept or strategy. So this next part, I want to talk about timing your trades, because that's a question that usually pops up. How do you actually execute? Well, there is no perfect time really to place a trade when it comes to news. You just want to prepare. So if you know there's going to be a high impact announcement and you're at a given area waiting for price to push up and it's already pushing up a little bit, I wouldn't keep that trade active, because what could happen is your trade goes haywire and you potentially lose a trade that would have won if there wasn't a announcement. But conversely, if there is about to be an announcement, what I like to do is place a buy limit order or a buy stop at which price is currently at, so that once it hits that area, I might be able to capitalize on a spike in the market if it decides to fluctuate. So one example could be NFP. Let's say there's a huge spike and it wicks off an area in which I placed a buy stop order. It's going to be much harder to execute that trade manually in present time because price is moving so fast. Okay, so we have preemptive trading, placing trades based off anticipated news outcomes; reactive trading, quickly executing trades after news is released, trying to capitalize on immediate price movements. Now, this is a little bit risky. I don't really recommend this because it can turn into gambling if you're like scalping, you're trying to, catch quick pips or quick ticks in the market. So it really depends on your trading method, your strategy, how you analyze the market, because what I don't want you guys to do is go in and out, in and out, in and out, and then over leverage and blow your whole account, or go over your weekly percentage that you're trying to work with. Okay, so that is all dependent on what type of trading style you go off of, right? So next we have global news monitoring. So keeping track of international sources for commodities tied to specific regions, such as the OPEC announcements for crude oil. And of course, you have the option to subscribe to financial news sources like Bloomberg or CNBC for timely updates and analysis. So you have the option to subscribe to any of the websites that I talked about, and it will basically notify you on your phone whenever there's an announcement being held or about to be held on that current day, which I find extremely helpful. By combining a strong understanding of how various types of news affects future markets and using tools to anticipate or react to events, you can make informed trading decisions and maximize your profits. And there you guys have it. That was how to trade news and understand the fundamental analysis approach when it comes to day trading. Hopefully you guys found this video helpful. If you did learn something today, a like would be extremely appreciated. Leave a comment or two on what you guys think about the video. If you guys need more help with the fundamental approach to day trading, also let me know and I'll be more than glad to make more videos like this, as I do enjoy making them. Always remember, we're in for the long game, not the short game. Until next time, see you guys in the next video. I'm out. Peace.